Gold moved toward $5,200 with steady force. Headlines spoke of rising geopolitical tension, fragile banks, stubborn inflation, and governments struggling with record debt. Safe haven demand was climbing across continents. Central banks were adding to reserves. Retail investors were buying coins and bars. Market volatility was picking up in equities and bonds at the same time. Under normal conditions, this is the kind of environment where gold does not hesitate. And yet, as price approached $5,200, momentum slowed. The breakout attempt stalled. The market touched the level, reacted, and pulled back, not violently, not dramatically, but enough to signal resistance. That is the contradiction. Fear appears to be rising. Financial conditions are tightening. Liquidity is uneven. Credit spreads are widening in parts of the system. If this is what stress looks like, then why is gold struggling to decisively clear a level that seems tailor-made for a breakout? To understand why this matters, we have to step back from the daily candle charts and think about what gold represents. Gold is not just a commodity. It is a barometer of confidence in the monetary system. It reflects trust, or the lack of it. When markets lose faith in banks, bonds, or currencies, gold often becomes the quiet recipient of that doubt. That is why $5,200 is more than a number. It is a psychological threshold. Round numbers anchor expectations. They shape narratives. They influence positioning by large institutions. A clean break above that level would not just be a technical event. It would send a signal that something deeper has shifted in the global financial structure. Instead, we have hesitation, and hesitation during a period of visible strain is information. Equity markets are swinging sharply from week to week. Bond yields are moving in ways that suggest uncertainty about growth and inflation. Currency markets are reflecting tension between dollar strength and global funding stress. Safe haven demand is not limited to one region. It is broad. Yet gold's reaction is measured. When the traditional crisis asset fails to surge during rising instability, we have to ask a more difficult question. Is the system stronger than it appears? Or is there a hidden layer of pressure that is temporarily holding price in place? This is where the story begins, because markets do not operate on emotion alone. They operate on flows, on liquidity, on leverage, on positioning. A breakout failure at a major level can mean many things. It can signal exhaustion, it can signal manipulation, or it can signal something more structural. Competing forces beneath the surface. Perhaps institutions are selling to meet margin calls elsewhere. Perhaps derivatives positioning is capping short-term upside. Perhaps central banks are influencing liquidity in ways that distort price discovery. None of these explanations require conspiracy. They require plumbing, and plumbing is rarely visible in headlines. What we are seeing at $5,200 may not be weakness in gold. It may be tension in the system itself, a system trying to balance inflation against deflation, debt against growth, liquidity against solvency. The key point is this: in moments of true clarity, markets move cleanly. When they hesitate at critical levels, it often means forces are colliding. So the failure to break higher is not a conclusion. It is a signal. And to decode that signal, we need to examine what has changed in the rulebook. Because if gold is not behaving the way it historically does during stress, then perhaps the rules of this cycle are already different. If the hesitation at $5,200 is a signal, then we need to revisit the rulebook. Historically, the pattern during stress has been consistent. When equity markets fall sharply and bond yields decline as investors seek safety, gold tends to move decisively higher. It becomes a release valve for fear. In 2008, during the global financial crisis, gold initially dipped as investors sold what they could to raise cash. But once central banks unleashed liquidity and confidence in banks deteriorated, gold surged. In 2020, when the pandemic shock froze global commerce, gold again broke higher as real yields fell and stimulus expanded at historic speed. Even during more recent regional banking stress episodes, the pattern was familiar. Deposits moved, volatility rose, and gold responded quickly. The traditional relationship is rooted in simple mechanics. Falling real interest rates reduce the opportunity cost of holding gold. Rising uncertainty increases demand for assets without counterparty risk. Weakening confidence in financial institutions pushes capital toward tangible reserves. These dynamics have repeated across decades. But this time, something is misaligned. We have rising geopolitical tension. We have heavy sovereign debt loads. We have central banks, particularly outside the West, steadily accumulating gold reserves. We have visible stress in parts of the banking system. And yet, when price approaches $5,200, it stalls. To understand this divergence, we have to look beneath surface demand and into market structure. Gold does not trade in a vacuum. It trades within a global liquidity network. Large institutions hedge exposures across asset classes. Hedge funds manage leverage. Banks manage balance sheets. When volatility rises in equities or credit markets, margin calls can force investors to sell profitable positions to cover losses elsewhere. Gold, being liquid, can become a source of cash. That dynamic creates short-term selling pressure, even in an environment of long-term demand. Then there is the derivatives layer. Futures contracts, options positioning, and algorithmic strategies can amplify resistance at well-known price levels. If $5,200 becomes a crowded trade, with speculators positioned for a breakout, even small counter-moves can trigger profit-taking or stop losses. What looks like fundamental weakness may simply be positioning imbalance. Institutional hedging flows also matter. Large asset managers rebalance portfolios mechanically. When gold rallies sharply, allocations may exceed targets, prompting partial sales. These flows are not emotional, they are systematic. This is why the stall matters. When safe haven demand explodes but price fails to follow through, it often signals cross-currents. Demand is real, but so is the need for liquidity. Buying is strong, but so is institutional discipline. Confidence may be eroding in one corner of the system while being defended in another. The key insight is subtle. Gold's hesitation does not automatically mean that fear is misplaced. It may mean that the system is absorbing stress in complex ways. Liquidity can mask solvency issues. Derivatives can dampen price moves temporarily. Central bank policies can distort traditional relationships between bonds, currencies, and commodities. In other words, the rules are not broken. They are interacting with new constraints. And when constraints tighten, pressure builds invisibly before it becomes visible. So instead of asking why gold failed at $5,200, perhaps the better question is this: what forces are strong enough to contain it for now? Because if demand is rising beneath the surface, and if liquidity pressures are capping price in the short term, then the real story may not be on the chart at all. It may be in the structure of supply, ownership, and control that sits underneath the market itself. That is where the next layer of this story begins. If the chart is not telling the full story, then we have to leave the trading screen behind and follow the metal itself. Gold does not begin as a ticker symbol. It begins in the ground. It is mined in concentrated regions: China, Russia, Australia, Canada, parts of Africa, and Latin America. Extraction is capital intensive. It requires long permitting cycles, energy, heavy equipment, and skilled labor. New discoveries take years to develop. Supply cannot be turned on quickly in response to price. After mining, the metal moves through refiners and vaulting systems. Large bars are cast, certified, and transported to financial hubs such as London, New York, Zurich, Dubai, and Singapore. From there, ownership can shift many times without the metal ever leaving storage. That distinction between movement of ownership and movement of physical gold is critical. At the sovereign level, central banks have been steady buyers. Over the past decade, and especially in recent years, emerging market central banks have increased their allocations. They are diversifying reserves away from heavy reliance on the US dollar. For countries exposed to sanctions risk or currency volatility, gold is not speculation. It is insurance. It carries no counterparty risk and no political condition. This is where the story shifts from markets to power. When a nation increases gold reserves, it is making a statement about monetary independence. It is reducing vulnerability to external financial pressure. In a world of rising geopolitical tension and fragmented trade systems, that choice matters. Gold becomes part of a broader strategy, securing payment channels, stabilizing domestic currencies, and preparing for a less predictable global order. But here is the deeper tension. The physical gold market is relatively small compared to the financial structures built on top of it. Futures contracts trade volumes that exceed annual mine supply many times over. Exchange-traded funds allow investors to gain exposure without handling bullion. Over-the-counter derivatives enable large institutions to hedge or speculate with significant leverage. These paper instruments serve a purpose. They provide liquidity. They allow price discovery. They make hedging possible for producers and consumers. Yet they also create layers of claims on underlying metal that far exceed the immediately deliverable supply. In normal conditions, this system functions smoothly. Most participants settle in cash. Physical delivery is rare relative to total trading volume. The paper market absorbs shifts in sentiment without straining vault inventories. But during periods of rising stress, the relationship between paper claims and physical demand becomes more sensitive. If more participants seek delivery instead of cash settlement, inventories tighten. If central banks accumulate steadily while private investors increase holdings, available float shrinks. Meanwhile, mining output grows slowly and is vulnerable to energy costs, labor disputes, and regulatory shifts. This is why the failure at $5,200 cannot be viewed only through a technical lens. It sits at the intersection of liquidity, leverage, and scarcity. On one side, leveraged paper markets can dampen price spikes, especially when speculative positioning becomes crowded. On the other side, physical supply cannot expand quickly to meet sustained demand. The system balances as long as confidence in settlement mechanisms holds. But confidence is not static. If geopolitical blocs continue to diversify reserves, if trade flows fragment further, and if trust in major currencies erodes incrementally, gold's role evolves. It shifts from portfolio diversifier to strategic asset. That shift does not happen overnight. It builds quietly through policy decisions, reserve disclosures, and bilateral trade agreements settled outside traditional channels. Seen through this lens, the hesitation at $5,200 is not simply resistance. It may represent the financial system's attempt to reconcile growing physical demand with a leveraged pricing structure. And once we understand that tension, the next logical question emerges. How does this physical and geopolitical struggle feed back into currencies, inflation, and the broader architecture of money itself? Once we see the tension between physical scarcity and financial leverage, the next step is to widen the lens again. Gold does not exist outside the monetary system. It reacts to it. It measures it. At times, it quietly judges it. For decades, investors have used gold as a mirror of confidence in fiat currency. When trust in paper money weakens, gold tends to strengthen. When real interest rates fall, meaning rates adjusted for inflation, gold usually rises because the opportunity cost of holding it declines. These relationships are not perfect, but they have been durable. Real yields are especially important. If government bonds pay 2%, but inflation runs at 4%, the real return is negative. In that environment, holding gold becomes relatively attractive. It does not yield income, but it also does not guarantee a loss in purchasing power. That is why gold often climbs during periods of financial repression, when central banks keep nominal rates below inflation to manage debt burdens. Today, however, the picture is more complex. We are living in an era of debt saturation. Advanced economies carry sovereign debt levels that would have seemed extreme a generation ago. Servicing that debt requires either sustained growth, higher taxes, lower spending, or accommodative monetary policy. None of those paths are politically simple. At the same time, inflation has proven more persistent than many policymakers expected. Even when headline rates decline, structural pressures remain. Aging populations, supply chain realignment, energy transition costs, and geopolitical fragmentation. These forces create a floor under prices. Under such conditions, gold would normally surge decisively. Yet at $5,200, it hesitates. This divergence pushes us to consider other layers of the monetary architecture. Central banks are not passive observers. They manage liquidity through open market operations, balance sheet adjustments, and signaling. They defend currency stability when volatility threatens financial conditions. If the dollar strengthens sharply due to global funding stress, gold priced in dollars can stall even if underlying demand remains firm. A liquidity shortage can create temporary dollar strength as global borrowers scramble for funding. In those moments, cash becomes king. Investors sell assets, including gold, to raise dollars. The move does not reflect optimism about the system. It reflects urgency. This dynamic complicates the usual inverse relationship between gold and real yields. Yields may rise not because growth is strong, but because governments must issue large amounts of debt. Currencies may strengthen not because fundamentals improve, but because global liquidity tightens. So when gold struggles to break higher despite heavy demand, it may signal that monetary authorities are still containing visible stress. It may indicate that currency defense mechanisms are working, at least temporarily. Or it may show that markets are prioritizing immediate liquidity over long-term hedging. The deeper issue is trust. Trust in sovereign balance sheets. Trust in central bank independence. Trust that inflation can be controlled without destabilizing debt markets. Gold's price behavior reflects these layers of belief. A clean break above $5,200 would likely signal that confidence has shifted materially, that markets are beginning to reprice currency risk in a sustained way. A failure to break may instead suggest that the system is still managing perceptions, still absorbing pressure, still balancing between tightening and support. But pauses can be deceptive. Monetary regimes rarely change in one dramatic move. They erode gradually. Small policy adjustments accumulate. Fiscal deficits widen year after year. Central bank balance sheets expand, contract, and expand again. Over time, these shifts alter the foundation of the currency system. In that context, $5,200 could represent a consolidation before a larger repricing event. Or it could mark a phase where markets choose liquidity and safety in cash over exposure to volatility. The key insight is that gold's hesitation forces us to think beyond price action. It invites us to ask how money itself is evolving in a world of high debt, structural inflation, and shifting geopolitical alliances. And once we ask that question, the implications move from abstract policy debates to something more personal, because changes in monetary architecture eventually filter down to households, savings, and everyday economic life. When monetary architecture shifts, even slowly, the effects do not stay confined to central banks or trading desks. They move outward. They filter through asset prices, lending standards, wages, and confidence. Over time, they shape daily life. Market stress often appears first in portfolios. Retirement accounts tied to equities and bonds can swing sharply when volatility rises. If bond yields move unpredictably because of fiscal strain, fixed income allocations may not provide the stability investors expect. If equities reprice due to tighter liquidity or slowing growth, long-term savings feel the pressure. At the same time, purchasing power becomes more uncertain. Persistent inflation, even at moderate levels, compounds quietly. Essentials such as housing, healthcare, insurance, and food absorb a larger share of income. When real wages fail to keep pace, households feel squeezed, even if headline economic data appears stable. Lending conditions are another transmission channel. Banks facing higher funding costs or balance sheet uncertainty tighten credit standards. Mortgages become harder to secure. Small businesses face stricter loan terms. Expansion plans are delayed. Over time, tighter credit flows into slower hiring and weaker job growth. These changes rarely happen all at once. They unfold in layers. This is why understanding the underlying dynamics matters more than reacting to a single price level. Gold failing at $5,200 is not simply a trading event. It is a signal within a broader system adjusting to stress. To interpret that signal calmly, we can rely on a few simple mental models. First, liquidity versus solvency. Liquidity refers to access to cash or funding in the short term. Solvency refers to whether assets exceed liabilities over the long term. A system can appear solvent on paper while facing liquidity pressure beneath the surface. During such periods, asset sales may occur not because institutions are bankrupt, but because they need cash quickly. That distinction helps explain why even strong assets can stall during stress. Second, paper claims versus physical assets. Modern finance is built on layers of claims. Shares represent ownership in companies. Bonds represent claims on future payments. Derivatives represent claims on price movements. Gold, in its physical form, represents a tangible asset without counterparty risk. During stable times, the difference may not matter much. During stress, ownership structure becomes more important. Understanding who ultimately controls an asset and under what terms provides clarity when volatility rises. Third, short-term volatility versus long-term repricing. Structural economic shifts rarely unfold in a straight line. There are rallies and pullbacks, breakouts and failures. A stalled breakout does not invalidate a longer-term trend. It may simply reflect positioning, liquidity cycles, or policy responses. Recognizing this prevents overreaction to isolated moves. Thinking in layers rather than headlines changes the emotional tone of analysis. Instead of asking, "Is this the end?" we ask, "What phase are we in?" Instead of assuming a single outcome, we consider probabilities and pathways. When viewed through these models, gold's hesitation at $5,200 becomes less mysterious. It becomes a data point within a macro transition shaped by debt, inflation, geopolitics, and monetary policy. It tells us that forces are interacting, not that conclusions are final. And once we frame the present this way, the natural next step is to explore where those interacting forces could lead, because the future will not unfold in only one direction. Once we accept that multiple forces are interacting beneath the surface, the future stops looking like a single path. It becomes a range of scenarios, each shaped by how liquidity, policy, and confidence evolve from here. The first scenario is a deeper liquidity squeeze. In this outcome, volatility spreads across asset classes. Credit conditions tighten further. Funding markets show strain. Investors facing losses elsewhere raise cash wherever they can. Gold, despite strong long-term demand, experiences temporary selling pressure as institutions meet margin calls or rebalance risk. In this phase, price weakness would not necessarily signal declining belief in gold's role. It would reflect urgency. Cash would be prioritized over assets. The dollar could strengthen temporarily as global borrowers scramble for funding. Gold might pull back from $5,200, frustrating those expecting an immediate breakout. But liquidity squeezes do not last forever. If central banks respond with expanded support, or if funding stress forces policy easing, gold could later break higher with more force. In this scenario, the failure at $5,200 would look less like rejection and more like compression before release. The second scenario is stabilization. Here, central banks successfully contain volatility. Inflation trends lower without collapsing growth. Bond markets find equilibrium. Fiscal pressures remain, but they do not trigger panic. In this environment, gold consolidates in a broad range below and around $5,200. Safe haven demand continues, especially from central banks and strategic buyers. But speculative enthusiasm cools. Price action becomes less dramatic. Markets adapt to a slower, more managed transition. Monetary authorities walk a narrow line between tightening and support, avoiding sharp shocks. In this case, the $5,200 level becomes a ceiling for a time, not because gold's role is diminished, but because confidence erodes gradually rather than abruptly. Structural pressures build quietly. The repricing of money happens in stages, not headlines. The third scenario is more decisive. A currency shock, a sovereign debt event, or a sudden loss of confidence in a major bond market forces rapid reassessment. Real yields move sharply negative. Capital controls or emergency measures appear in parts of the system. Investors begin to question not just growth prospects, but the stability of reserve currencies themselves. In that environment, gold's hesitation would likely end. A decisive break above $5,200 would not be about momentum trading. It would reflect a shift in monetary expectations. The metal would be repriced as a strategic anchor rather than a portfolio hedge. None of these scenarios are certain. Each depends on policy choices, geopolitical developments, and the behavior of market participants under stress. The purpose is not to predict a specific outcome, but to understand the conditions that would lead to each path. The important point is this: the failure at $5,200 is not a conclusion. It is information. It suggests tension. It suggests competing forces. It suggests that the system is adjusting. Markets often whisper before they move loudly. They test levels. They hesitate. They probe for liquidity. Only later do they reveal the dominant trend. So the question remains: if gold cannot break decisively higher during visible stress, what catalyst would finally force the system to reprice risk in a sustained way? Would it come from the bond market, where sovereign debt burdens are heaviest? From central bank policy shifts that redefine liquidity conditions? Or from a geopolitical event that accelerates currency realignment? That is where the next layer of this story leads into the heart of the bond market and the policy decisions that quietly shape everything else.